it was the last homework. Okay, sorry. So let's survey your investment idea with a motivating example that illustrates why you are the manager. RAR code for numerical integration and differentiation or arbitrary univariate function. So you all know the definition of the differentiation, right? Actually, that was one of the purpose of this homework. There are several alternative ways to define differentiation, but my favorite, actually one of the most popular definition is this one. Oh, sorry. Right, this one. So basically, limit function, this is not available in R. So what you have to do is that you have to write a program that calculates this part, and if we make h small and small, right, then it becomes like approximately we can get a differentiator. So let me write a very small program about this. Differentiation.R. Okay. Finally, but edit. Too long, maybe. Edit. Okay. And then I have to start R. And then let us go to the working directory. So working directory is basically C, right? C and temp. Okay, I think it is right. Temp. Okay. 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 So we went to the working directory. So we can write the code, and if we can execute our code here now. For example, to execute our source code, it is like a source, and then dir. It works. Okay. And about numerical integration. Okay, so basically, there are many ways to write a program, but one possible way is actually to define a differentiating function. So let me write a function like diff. Okay, diff. Okay, it is not the same to file name, so diff 0. Just a df, okay? df. Let's call df is the name of the function, okay? Name of the function to the differentiation. So is a function, okay, and the first argument is a function, okay. So given function, I want to do the differentiation, and I have to determine at which point I want to do the differentiation. So maybe I want to do the differentiation at x, and then third argument is should be like h, okay, the extent of approximation or precision of the differentiation, okay. So type h, okay. So what? So basically my df is basically we can simply write down this part, right? So f x plus h minus f x minus h. Okay, and df minus divided by 2h. Okay, I think it is done now. Okay. So let me do the differentiation like df sine function. Okay, let's do the differentiation sine function at 0 and 0.1. Okay, something like this. Oops. Okay, I want to see the df. Yeah, so it gives me the answer, right? So basically what it does is, in sine function, okay, sine function around so sine function looks like this, right? So it is a pi 2pi, right? And I want to do the differentiation about here, and to make approximation, I set h equal 0.0, right? At 0.1, so around at this very small interval, I want to pick this one and pick this one. Then basically, what I just computed is the slope of this line, right? And we all know that slope at this point is basically should be 1, right? So to our answer, so the answer is that, okay. Basically, we know 0 is cosine 0, so it should be 1, right? It should be 1. But as you can see, our numerical, it is not exactly 1. It is close to 1, but not exactly 1, because h is not, it should be close to 0, but it is 0.1, right? 0.1, so it is only approximated value. But we know if we make this h smaller and smaller, then the differentiated value should be closer to, okay, should approach to 1. So let me try. So right now, this value is now closer to 1 than the previous, right? So easy, right? Very easy. Okay. And about numerical integration, it is as easy as this one, okay, but it needs slightly more. You need actually slightly longer code, and I don't want to spend the time about that. So, okay. Anyway, since I gave you answer about numerical differentiation, so why don't you try numerical integration again for your homework, okay? Because I saw most of your answers are quite, you wrote some code, but a lot of your solutions for most of the students are not correct, I think. So please do it again, okay? For numerical integration. Anyway, to check whether sine is close to differentiation of the sine is whether it is close to the same to cosine 1. Let's check. Let's draw some, okay, plot function. Okay, draw down plot. So basically, plot. Okay, first let us draw the sine function, graph of the sine function. So how can I do that? Okay, so input in is like 1 to 10 divided by multiplied by pi. Let me check. Pi. Okay. Pi and divided by 20. And 10. Okay. So it is like input. So let me type this one. Okay. Then okay, I have to find another name in 0. Okay. Zero looks like this. Okay. So basically, first one colon 20 is just 1, 2, 3, 4, 5, 6, 7, and 20, and I multiply pi and divide by 10. Okay. So it is a point 20 point between 0 to 2 pi. Okay. And I wanna see the graph about this. So plot. Okay. Sine 0 and then type, okay, and then we have something like this. You look familiar to sine function, but I want fancier graph, so type L. If we type L, it is line, so instead of dot, it's the line. So, let's see. So it is the sine function very familiar. And let's check cosine. Let's check the graph of the differentiation of the sine. So sine, and to do that, okay. Okay, let's see. Out 0. Let's define in 0 multiplied by 0. Okay, and now it is a array 20 with 20 elements, but it is all now filled with zeros. Right? And I want to fill this array with differentiated value of the sine function. Okay, so let's see. So for I 0 to 20, and I wanna define out 0 ith element as the df, and then sine, okay, sine function, okay, and then x is the input variable, so in 0 I, and then my approximation, let's say, is 0.1. Okay. So okay, basically what it does is a basically roof. Okay, roof. So roof from 1 to 20, and then my out 0. This array is now filled with 0, and I want to fill each element of this array with this new value. This new value is to the numerical differentiation of the sine function at this point input at I. Okay, so ith element of this array with approximation on the neighborhood of 0.01. Okay. So basically, you have to use this 4-sentence loop, this syntax to do the numerical integration. Okay. So let's see. Let's run the program. So source. Okay, and then out 0. Let me try. Out 0 looks like this, and I wanna see the graph of this one. Out 0 and type L. Okay, and right. So it looks like cosine function. Okay. Right. You remember cosine function, right? That you already learned in high school. So if you do the differentiation of sine function, it's cosine function. Okay. Any question? It's very easy, okay? Not easy. It should be easy, okay?
Looks like easy.
Yeah.
It looks easy, but I guess it will be very tough when I do such a.
Yeah, so yeah, please write it down now, okay? And then it is not wrong, so you can just memorize it. Memorize this syntax. And this syntax is basically very intuitive, right? This syntax is in line with really the mathematical operations that we already know. So it is not difficult to remember. Any question about homework? Okay, so please do the homework again. So next homework is, okay, let me add this one. Adding, login. Okay, homework for next week is, okay, I want to add homework 2. Numerical integration. Okay. Save. Okay, about next week's homework, it is with R coding for write bond pricing function and compute duration and convexity of bond numerically. Okay, that's very easy. You know the bond pricing function, right? We already covered this in the class. If you use continuous compounding, continuous discounting, basically bond pricing function, formula for bond pricing is basically, let's see, okay, so let's ARP is coupon rate. Right? And so basically, RF is the coupon, and K, let's say K is number of coupon payment per year. Okay, and then we have to discount it with, suppose interest rate is R, yield to maturity is R, and we have to discount it with some T. T, okay, and so T should be from 1 to K multiplied by T. Okay, and then plus, roughly speaking, okay, is F E minus R okay, actually it should be K divided by K R T. Okay, so it is bond pricing function. Okay, P is the bond pricing function. Okay. You all remember this, right? So it is bond pricing function. Okay, so what you have to do is first you write down write R code to calculate bond price given coupon rate, number of coupon payments per year, and F face value, and then R yield to maturity. Okay, so given this information, you wanna calculate price of the bond. Then next, once you calculate price of bond, then you need to compute duration and convexity. Okay, duration and convexity. duration is worth just a differentiation of this bond price we need negative. So it is just a duration, right? It's definition of duration. So you already know how to do the numerical differentiation, right? Of course, actually, you can solve this. You can do the differentiation by hand, okay, using this function. But alternatively, since you are now experts in doing numerical differentiation with R, so you can now apply your expertise to calculate this, right? Right, so basically, you if you go to this code, basically instead of sine function here, instead of sine function, okay, I need differentiation for sine function. But instead of sine function, what you have to do is you have to use your own bond function for differentiation. Of course, you have to normalize your price. Okay, that's very easy, right? And so it is one. And next one is the convexity, right? Bond convexity is just second derivative, which is, so now you have to do the differentiation one more time, right? So you apply your numerical differentiation second time. Right? So convexity is RP. Am I right? I forgot the formula. Just a moment. I'm not sure whether we need to divide by 2 or not, but bond convexity. How can I get rid of? Go away. Bond convexity. Bond convexity is in Wikipedia, Investopia. So formula for bond convexity is, where is the formula? Not good. Okay, bond convexity is, okay, basically this is right. So divide, we don't need 2 here. So this is the bond convexity. So basically you apply, so it is a second derivative, right? Second derivative, so it means that you have to do differentiation 2 times. Okay, and divide by P, which is the convexity, okay? So since you already learned today how to do the differentiation, so you can do this homework. Any question?
So what is the formula difference between those? I think
it is the same, right? It is a convexity and this is a convexity. So P is B there, okay, same. Okay, so let's align our notation. So B is the bond price. So this is the duration. Any question? Okay? Not difficult. Okay, you all can do that. Okay. Good. And then I want to also check your homework about investment idea. The previous homework was, okay, submit your investment idea with a motivating example. Okay, let me check. Okay, instead of going one by one, why don't we looking at this one? Okay, I want to ask you one by one. So first, Odahe, could you please explain your investment idea again and briefly discuss motivating example?
I think I best want to
Okay.
Because
So what is your investment idea? What is your proposal?
I don't want to invest anything. Just I want to certain money. But if I should invest something, then I should invest gold. I think.
Okay. Did you submit your homework? 오다해. Okay. You submitted your homework. Okay. Submit your investment. Okay. Actually, I don't like investment, but if I have a very good chance, I invest in stock and. Okay. If you don't like investment, why do you take this course?
I have to.
You have to.
Because
You don't have to. Okay.
graduate.
You, in order to graduate, you have to take this course.
And so I need some.
There are many other finance courses out there.
But it's already full.
Okay, other classes are popular and my class is not popular. Okay, so that's how you can register. Oh, that's sad. Okay. Anyway, I don't care about your registration program. If you are taking this class, I have to assume that everyone is interested in investment. Therefore, you should do the homework also. Okay. And next, 한원혁, what is your investment idea and motivating example?
Can I check my homework?
Okay.
It's previous.
Is it previous homework?
Okay.
Okay. And then sorry. Strange, I cannot find your homework. And you just explain
okay.
verbally, okay?
My investment idea is buy Codex 200 ETF for 3 years as the way you subscribe to instrument fund. My assumption is Korean stock market increases at least every 3 years, and Kospi 200 is consisted with very competitive corporation. I mean, inside Codex Kospi 200, it's only good company can enter the Kospi 200. So there will be in and out, and I have to buy the same volume of Codex 200 ETF every month. So the advantage of my investment idea is there will be less fluctuation. So it has advantage in mid and long-term investments. And I don't have to spend a lot of time to searching good stocks. It means it's also as part of investment. My time is also, I think it's the thing I should invest. And tax is relatively cheaper than mutual funds. And it reduces risk of individual companies such as bankruptcy events. So my conclusion is take the market rate. I mean, even experts investor fails to exceed market rate. So I just expect Korean market will increase at least 3 years. Then I will wait and buy Codex 200.
Okay, good. By the way, by the way, please explain your investment idea with one sentence, and please explain why your investment idea is important also with just one sentence with an example. Okay, we don't have time, just one sentence each. Okay, 송영원.
My investment idea is separating my asset into two parts. One is for short term and for profit, and second one is for long term investment and rather less fluctuating. Yeah, I think I did mischose the motivating example, but I choose the Japanese earthquake case. After the earthquake crisis, the constructing industry stock price was higher. In my case, I'd like to invest my first part of my investment into such a portfolio of constructing industry stuff in Japan. And secondly, in my long-term investment cases, I expect the energy market demand will be increased, especially crude oil in short term, and in long term, the alternative energy will be alternative energy market will be emerging. So yeah, that's what I did, but I think I'm not so good.
Okay, good. And yeah, please again explain your idea in one sentence each. Okay, short, brief. Okay. Yeah. 강주연.
I make my home with two big reasons. First one is make a portfolio mixed with risky stocks and stable stocks together. Because I prefer stable investment than risky investment. And I got this idea from this book, What is Investment?
Okay.
By Countryside Doctor, written by Countryside Doctor.
Okay, thank you. 이지수. 또 주창모.
My investment idea, I have two. First, in the short term, I invest for the cost up and the technology, right, in technology market, based on my knowledge. Because in that case, I can know like how the company works and what their business are. And in the long term, I'm gonna invest for commodity related, because due to inflation, I think every resource will be going out. So I think the stock price will be going up.
Okay, thank you. 이지수.
My investment idea would be to find out the fundamental value of the company, but then I haven't selected which industry specific that I would like to invest in. But then there are lots of ways to find out for the fundamental value, but I'm trying to see for each one and then eventually select the one that is expected to have much value.
Okay. 오병철.
Yes, my investment idea is how can investors make excess return with CSR index? CSR index is corporate social. CSR stands for corporate social responsibility. And why is my investment idea importance is simply CSR index return is making higher than benchmark index. That's the reason I think it's very important.
Okay, Wouter?
Yes, I would invest in developing nations and regions. And the reason why I would do this is because my preference is India. And the article I've submitted 3 articles. One of them is that Warren Buffett at the moment is in India himself. And he says it's a logical choice. Not because I follow Warren Buffett, but because I think that's a good extra argument to choose for me.
Okay, thank you. I forgot your name. Well, okay. Sorry.
My idea was investing in something and getting profit out of it. Investing, putting money in something and getting out of it as profit. And my example was bonds, bank bonds, bonds from bank. When you borrow, when you invest your money in bank, they will give you profit and use your money as use your money to borrow it to someone else and getting profit from that. So it's like 3 persons are doing the same thing and getting profit.
Okay.
Okay, my idea is that I would invest in treasury bonds because I think it's more safer and long-term investment, and it's easy to buy. And I think in this crisis, like what investors really want these days is the safe money. They want their money to be protected and all that. So I think that's something about treasury bonds.
Very good. Angelica?
I made some research for the small investments ideas actually, because we are all small investors, and I suggested to invest in the market stock, but not in the hot industries, but in the blue chip stock, which is more safer and I guess in a lot of cases a lot of profit there. You can get some profit with this. And I suggested to invest in the government bonds as well, because you can get more interest rate in there.
Okay, Convexity.
My investment idea is to buy low and sell high, but we don't know when it's low or high, so I use Anthony Graham's value investing. So we have to get our own full information about financial statements. To get its intrinsic value. So when my intrinsic value is, when the market price is lower than the intrinsic value, or the PER or PPR is lower than the industry average, then I will invest in that.
Okay. Talk to you.
I suggested to invest in IT company because this company growth, there will be a competition among the smartphone making companies, right? I think making portfolio investments on those three companies will prevent the investors from having risk, because if the investors do the investment portfolio investments on those companies, the consumers are likely to get the product either in the three companies, right? So I think the loss and profit will offset each other. So I think that can eliminate the risk of losing money.
Okay, Lang.
My opinion is to invest in new stocks.
Where?
New stocks.
Oh, new stocks.
Emerging market new stocks. I use the data on conversation to calculate the risk, to calculate the market return about the new stock. I can compare decided to buy which stock we should invest in. And also there are some market like this extend this time. It's a kind of formula in that too. It is called data equation.
Okay.
Use of the
I will ask this again next week, so please prepare your answers very well, okay? Why, what is your idea, and why does it matter? And explain that with an example. Because this is not simply checking the homework. This is, if you get a job in finance sector, this is actually, it depends on job of course, but if you work on investment bank or asset management fund, it is what you have to do in front of your client. It is one of the most important communication, okay? So it is called pitching your investment idea. So your clients are always interested in making money and you have to get their attention, right? And so what you have to do is you have to explain very professionally, and usually they are very busy, right? And you have to get their attention in very short moments, with very succinct argument. Simply explain, my investment idea is ABCD, and it is important and matter because of this, for example, something like this, okay? This is very important exercise in field, okay? So I want to practice this in this class, okay? So please prepare again, please prepare your answer again. I'll ask you next week. This is very important exercise. And let's go to today's homework, not homework, today's presentation. So Chris is not here, so June is the only presenter today. Okay.
Hello, my name is Jiyeon Park, and I'm going to present a presentation about efficient diversification. So let's begin. In this chapter, so first I'm going to explain diversification and portfolio risk first, and then second, asset allocation with two risky assets. And thirdly, the optimal risky portfolio with a risk-free asset. And fourth, efficient diversification with many risky assets and a single index asset market. And finally, I'll talk about risk of long-term investments. So these are the index that I'll cover today. When it comes to investment, it is very common for people to think about risk that might follow after the investment. As a solution for the risk that might come after the investment, many people tend to diversify their investment.
more easily, they put their eggs into different baskets. Have you heard about the expression, don't put all the eggs into one basket? This is how the portfolio investment is. So next I'm going to talk about asset allocation with two risky assets. The risky portfolio is simply comprised of stock and a bond fund in given proportions. Of course, investors need to decide on the proportion of their portfolio to allocate to the stock versus the bond market. This is an asset allocation decision. We turn now to asset allocation between two risky assets, which I will continue to assume are two mutual funds. One is bond fund and the other is stock fund. It turns out that the key determinant of portfolio risk is the extent to which the returns on the two assets tend to vary either in tandem or in opposition. Portfolio risk depends on the correlation between the returns of the assets in the portfolio. We can see why using a simple scenario analysis. And for the efficient diversification with many risky assets, I'm going to talk about the efficient frontier of risky assets. The efficient frontier of risky asset is basically a graphical representation of a set portfolio that maximizes portfolio expected return for a given level of portfolio standard deviation. Rational investors will choose a portfolio on the efficient frontier. A portfolio manager identifies the efficient frontier by first establishing estimates for the expected returns and standard deviation and determining the correlation among them. The input data are then fed into an optimization program that produces the investment proportions, expected returns, and standard deviation of portfolios on the efficient frontiers. And for a single index asset market, to simplify analysis, the single index model assumes that there is only one macroeconomic factors that causes the systematic risk affecting all stock returns, and this factor can be represented by the rate of return on a market index, such as S&P 500. According to this model of single index assets, the return of any stock can be decomposed into the expected excess return of the individual stock due to the firm-specific factor, commonly denoted by its alpha coefficient alpha, and the return due to macroeconomic events that affect the market. And here's the equation. Here, beta measures stock's comparative sensitivity to the economic then average stock. And here, RM that comes after beta is excess return on a broad market index. And here, E measures expected value, and alpha represents the expected return on the stock beyond any return induced by movements in the market index. Therefore, as you can see in the equation, the BIRM, BIRM, that's in the middle. It represents the stock's return due to the movement of the market modified by the stock's beta, while E represents the unsystematic risk of security due to firm-specific factors. Macroeconomic events such as interest rate or cost of labor causes the systematic risk that affect the return of all stocks. And the firm-specific events are the unexpected microeconomic events that affect the returns of specific firms, such as the death of key people or the lowering of the firm's credit rating. That would affect the firm, but it will have a negligible effect on the economy. The unsystematic risk due to the firm-specific factors of a portfolio can be reduced to zero by diversification. The single index model is not only practical, but also is very convenient. So it's really popular among the investors. It relates to security returns to a market index that investors follow. And moreover, its usefulness will go beyond mere conveniences. And finally, I'll cover the risk of long-term investments. We can think about two aspects. We can first pose a question about this. Are stock returns less risky in the long run? Here's my answer. Advocates of notion that investment risk is lower over longer horizons apply the logic of diversification across many risk assets to an investment in a risky portfolio over many years. Because stock returns in successive years are almost uncorrelated to each other, they conclude horizon, and hence investment risk in a stock portfolio declines with the investment horizon. Next, you can also think about the fly in the time diversification ointment. To illustrate this with a simple example, suppose that investors can invest in safe bonds and that the rate of return on all bonds is zero. The value of a stock portfolio in any year will either double or fall by 1/2 with equal probability. Okay. Thank you.
What is horizon?
Horizon? It's like it's basically representing the period. The time period. Okay, thank you.
You know, when we say horizon in the investment period, it is basically length of the period, not like horizontal vertical thing. Okay, what was you just presented about this one, right? No. Julian, you presented chapter 5, right? 6. Oh, you 6. Okay. So, okay. We need someone for chapter 5 and someone for chapter 7. Chapter 7 is very, very important. Okay. Okay, any volunteer for 5 and 7? Okay, which one? 5. And 7? Any volunteer?
I'll do.
Okay. Good. Thank you. And then let's review briefly what you learned last week. Diversification return. Okay. Yes.
Can we make the presenters to upload their portfolio?
Oh yes. Please. By the way, don't forget if you presented your, if you did presentation, please don't forget uploading your files. And, yeah, Fought already uploaded it, and yeah, one of you didn't do it, right? Didn't do that, right? So, okay, you uploaded it on the Easy Hub, right? So please upload it again into the Google Drive.
Send it to all.
Yeah, yeah.
Okay.
In order to upload your file, simply send it to the group email address. Okay, then it automatically uploads the file. So last thing, I basically illustrated. It is not free actually. Of course, you can, if you go to Bloomberg.com, you can see some news, but for the detailed information, you have to register and you have to pay a lot. So that's why I cannot use Bloomberg now. And about CNBC also, you need a cable TV to watch CNBC, right? Yeah. So instead, I nowadays watch Bloomberg TV. Bloomberg TV is available online. It is free, so it's, I think, a good substitute for CNBC. Where are they? I mean, break is only 15 minutes, not 20 minutes. Okay. So about diversification return, let me briefly go over what we learned last week. So in these two examples, even though they have the same average return, the total return is very different. So it means that it basically suggests, because it suggests that if we reduce the return volatility, maybe we can increase total return, okay? Given average return, right? So diversification actually can increase total return given average return. So that's very important result. And last week, based on, do you remember Taylor series extension? We learned last week. So based on Taylor series approximation, we have this relationship, right? So this relationship again suggests that if we can reduce the volatility SI square is the variance of the simple return on I. So if we can somehow decrease this one, okay, we can boost this one. Average return. Okay. When, as you know, one easy way to reduce this volatility is actually diversification. So which means that the diversification can increase your total return given arithmetic return. And the benefit, that part of increased return due to diversification is called diversification return. Okay, so again, okay, so ERI is the expected average return. We have to distinguish average return and total return. So ERI is the expected average return on SSI, and SI square is the variance of fiscal return on I, and log 1 from ERI is average return on I. Now we will express as a continuously compounded return. So this means that basically this equation means that the higher the variance of return, the lower the compounded return. Alternatively, the lower the variance of return, we can actually increase the higher the compound return. Okay. That's the direct benefit of diversification expressed in terms of return. Okay?
Sir, can you explain
Yeah.
what you said? Can you explain?
Yeah, there is one direct measure of the diversification. Benefit of diversification measured in terms of the return. Okay. The difference between average return and total return and basically average return on I. So actually we will go over this part again. So basically first, in order to get this idea further, first we have to know asset beta, asset I's beta relative to portfolio. So asset I's beta relative to the portfolio is calculated by replacing its return against the portfolio's return. So beta, when you say beta, just a moment. We will talk about asset beta a lot for this class, and whenever we say beta, it is a relative concept. It is relative to something else. In capital asset pricing model, beta is market beta, which means beta relative to the market portfolio. And in this context, when we say beta, it is a portfolio beta, okay? Asset I's beta relative to the portfolio. And beta has the mathematical definition of beta is basically it is a ratio between covariance and variance. Okay? So basically, we can express covariance between Ri and Rp in terms of beta and variance of the Rp. And it has very intuitive geometric meaning. So okay. So suppose x is this portfolio return, and y-axis is asset I's return. Okay. And over time, we may find the data about asset return and portfolio return. Okay. So over time, so maybe last year the relationship looks like this, and last month like this, today like this, maybe tomorrow, and today tomorrow. Right? So maybe we can find. This is the data about Ri and Rp. And this beta I, okay? This beta I, it basically means, okay, the slope of the line. Okay, so beta is the slope of the line that fits this point best. Actually, there are many ways to finding the line, fitting line for this point, but when I say the best fitting, it means the actually in minimize, okay, the distance, okay, let's say it is d, okay, basically this line minimize the distance between xi and this line, distance measured in terms of square root, okay, yes, square root. So let's say it is a length d1 and d2, so actually it is a plus sign, it has a minus sign, right? And when we say this fitting line, basically we wanna minimize this one. So squares. T is the length of there. So basically this line minimize this thing. Okay. And the beta is basically the slope of the fitting line. And this kind of finding line, okay, this kind of practice of finding line is called linear regression. Okay, therefore, the beta is basically linear coefficient of the linear regression. So anyway, we can express this coefficient in terms of ratio. It basically is the ratio between covariance and variance. And the covariance measure of each asset in the portfolio weighted by the assets represented in the portfolio will sum to the portfolio variance, which means that basically so portfolio return, okay, portfolio return is basically a linear combination of Wi, let's say it is a portfolio weight of an asset I in a portfolio, right? And Ri is the return of the individual asset. Therefore, when we calculate covariance, right? When you say basically covariance of RP is not covariance, okay? When you calculate the variance of the RP, it is basically covariation with itself. Right? It's covariance between RP and RP. Yeah, it is its definition. Right? And then we can plug this equation to here, so it is a covariance between Wi, Ri, and Rp. Right? And then upon the definition of covariance, we can plug this part out. Right? And then we know this covariance part is actually we can express with regression coefficient and the variance of the P actually. Variance of the RP. So basically we can cancel each side out, so this whole part is actually just one. So therefore, yeah, the covariance measure of each asset in the portfolio weighted by assets represented in the portfolio will sum to the portfolio weight, portfolio variance, right? So, yeah. So if we basically we can regard this portfolio variance as a weighted average of the covariance of individual asset. Okay, now based on this concept, actually let's measure the estimate of the contribution of the asset I to the compound return on portfolio P. Okay, so go back to this definition actually. So if we can decrease variance, somehow we can decrease variance, we can boost up this part, right? And we know one easy way to decrease variance is adding an asset to the portfolio diversification. So basically we can measure, now using that notation, definition, we can measure how an individual asset contributes to portfolio return through the diversification effect. One obvious measure looks like this. One obvious way to measure the contribution looks like this. So instead of the variance, basically we want to use covariance in the numerator, numerator. But there is one small problem of using this definition because the weighted average of the return contribution estimated from the above is not exactly portfolio compound return because the weighted average of this log 1 plus ERI is not exactly log 1 plus ERI. You can easily check it. So in order to address the problem, we can redefine the contribution of individual assets to the portfolio looks like this. Okay. So now the weighted average of the first term, okay, therefore we can, the weighted average of the first term is exactly log 1 plus ERP. Okay. And the weighted average of the second term is basically ratio between now weighted average second term because in line with the first term. Okay. So weighted average of this whole contribution of the individual asset therefore becomes portfolio, okay, portfolio's compound return. Okay. I mean instead of I we can put P, right? So it is a portfolio compound return and weighted average of this DI thing here will become the portfolio's compound return. Okay. And then in the next table, using this definition of measuring the contribution of small stocks to portfolio return rather than the compound return on the assets substantially increase the premium of small cap over S&P 500. So let's apply this definition Okay, this definition of measuring, these concepts of measuring contribution on real portfolio, especially small cap stock. So in this table, portfolio with very small stock between 1941 to 1990. So this portfolio is composed of 50% S&P 500, 10% of small cap stock of Gsti 9 and 10, which means that smallest 20%. US small cap 9, 10, so it is 9, 10 means that size. So it's making bottom 20% stock in terms of the size. Okay. And the 20-year treasury bond, 20%, and 1 month treasury bills. Okay, so we have cash, 1 month treasury bills, basically we decided cash and we can have the long-term bond. Okay, so we have a portfolio of 50% stock, large stock, 10% small stock, 20% long-term bond, and 20% cash. Okay, and we know average monthly return is respectively 1.03%, 1.37%, 0.39%, and 0.36%. Okay, and average weight of the portfolio, therefore, multiplying this number to this rate and add that, and we have approximately 0.8% portfolio average monthly return. And then standard deviation of each asset class is like this: 4%, 6%, 2%, and 0.28%. And weighted average of the standard deviation is 2.72%. And then we have a very interesting pattern. So this performance of this portfolio, okay, during from 1941 to 1990 is actually 9.17%. So this is the portfolio return over this period. But if we take a look at the individual asset class, compound return of each asset given this monthly return, actually, this compound return is 11% S&P 500, 14% small cap, 4.4% for long-term bond, and 4.3% for cash. And weighted average means multiply this and this portfolio weight, and sum them up, then we have return of 8.79%. So weighted average of individual asset class return is actually smaller than portfolio. And we know why this happens, right? It happens because of the diversification effect. Now we know how to measure the contribution, right, of each asset class to the diversification return. So applying the previous formula, actually we can compute return using diversification for each asset class. And S&P 500 is 0.4%, and small cap is large, 1.36%, and treasury long-term bond 0.16%, and for cash it is almost 0. So cash, the short-term bond, almost, it has little diversification benefit. Okay? And anyway, now we can add. Okay? We can add this compound return of each asset, and if we can add it to the diversification return, okay, then we have a new number, and the weighted average of this return, in terms of this weight, we have 9.17%, which is exactly same to the portfolio return. Okay. Any questions now?
Could you show us one of these within the formula, how you calculate it into maybe how you calculate 1.36% return due to diversification of the US market?
Actually, it is not possible given this data because we don't know the covariance, right? yes, we should know covariance between. Yeah, basically we have to calculate this one. So we know this, and we know this, and we know this, but we don't know this co-beta or covariance between them. So only given this information we cannot calculate. But actually I have another data which is Excel file, so I will illustrate that to you with another data. Anyway, this is a very interesting pattern. Okay, so small cap. Okay, small cap stock has very large diversification return. Right? So small stock, if we take a look at the small stock again, that doesn't look that attractive in some sense. Right? Small stock has relatively high return, but its volatility is much higher than the others. Right? So if we compute the ratio return, ratio between return and standard deviation, because it is based on, it is like 1/6, and it is like 1/4. So it seems like the small cap stocks are dominated by S&P 500. But in fact, the small stock create more value in your portfolio through diversification effect. Why? Why are the contribution of small stocks to the compound return on portfolio so much larger than the compound return on small stock? Right? So there is a question. So why you have such a large number, 1.36? The reason is that, okay, small stocks have high return variances, which lower their compound return. Right? So small stock has very high volatility, so it lowers this compound return. Right? So because small stocks are not, but one thing is that small stocks are basically not highly correlated with other assets. We don't know the exact information, but let's believe this. So small stocks are not highly correlated with other assets, however, and their risk in a diversified portfolio is much less than their return variance. Right? So although they're in asset class, in an individual asset, as an individual asset class, its volatility is very high, but once it goes into a portfolio, its risk is a lot diversified. Right? The covariance of their return with the portfolio return is much. So basically this part for small cap, this beta, actually this whole part is very small, which means the beta is very small. Beta is very small, so since this is small, this is large. TI is large, for small stuff. So, which means that this diversification benefit substantially increases the contribution of small stock to the compound return on portfolio. So, when we judge the benefit of individual asset in a portfolio, just looking at its own expected return and then standard deviation is not enough. Okay, we have to see how it creates diversification benefit in a portfolio. And in conclusion, okay, actually this story is similar for international stock, large or small. So international stocks have similar story from the perspective of US investors. International stocks are like small stocks. They have high return volatility compared with their return. But the thing is that international stocks have low covariance with US stock. Therefore, by including international stocks in the US portfolio, actually it can create a lot of diversification benefit. Anyway, in conclusion, the portfolio compound return is useful for describing portfolio return, while the compound return of an asset in a portfolio understates the contribution of the asset to portfolio compound return by ignoring the benefit of the diversification. Right? So if we, for example, if we only investigate these things, right? Average monthly return or standard deviation in each asset classes, basically we understate the benefit of these small cap stock, which actually create a lot of diversification return. So just looking at this, understate the benefit, especially this one. Okay. The return contribution is therefore an improved measure of the contribution of the asset to the portfolio compound return, and the portfolio compound return is an average of the asset return contribution. Okay. This is such an important concept, but interesting me even in field. In my MBA class, there are actually fund managers, and I asked them whether they measure diversification benefit in this way, and they said it is their first time to see these things. Okay. So I was very surprised. Okay. Yeah, this is very important concept, and I actually suggested fund managers to use this index, this measure, to assess, to determine whether to include a stock to the portfolio or not. Any question until now? Okay, let's go to related story. So one of the potential compound return driver is the diversification return, a term coined by Booth and Fama. So this part is actually summary of Booth and Fama's paper. And if you click this link, actually you can download their paper. So if you need more information, you can simply check the link. Okay. So the diversification return is again basically the difference between portfolio geometric return and weighted average geometric return of a portfolio constituents. And under certain circumstances, the diversification return can appreciably raise the geometric return of the fixed rate or rebalance or commodity futures portfolio. Okay? And in the previous literature shows, as the previous literature shows, with some minor and technical qualification, unbalanced portfolios such as market capitalization weighted portfolio are unlikely to benefit from a diversification return to the same extent as fixed rate rebalanced portfolio. Why? Do you know why is that? I explained this last week. Why? Why unbalanced portfolio are unlikely to benefit from a diversification return?
Because they are very much related.
That is a partially answer. The thing is that, again, in the unbalanced portfolio, it is like, let's go to the previous portfolio rebalancing. In the unbalanced portfolio, which is basically buy and hold strategy, and which is basically drifting mix. Okay, if you don't do anything about your portfolio, and the winning stocks, okay, those stocks which have had good performance the previous period will dominate the portfolio. Okay. Since some small subsection of the stock dominate the entire portfolio, then we have lower and lower diversification benefit. Okay. Yes, and this was the example as you remember. If we don't do drifting mix, it has a much lower information ratio, and eventually, even if we start like the same equity and bond portfolio, eventually equity part dominate the portfolio. So that's the reason. Anyway. Yeah. Yeah. So again, unbalanced portfolio such as market capitalization weighted portfolio are unlikely to benefit from a diversification return because the portfolio will lose diversification. It will be less and less diversified by giving more weight to the past winning stocks. And it is important not to confuse any of the return generated by rebalancing with risk premium. So basically, this kind of diversification return is not related risk in some sense. One of the fundamental premise in finance is the risk-return trade-off, right? We can expect high return if we bear more risk. In order to reduce risk, basically we have to sacrifice some return. So basically that's risk-return trade-off. So when we say some assets have high expected return, we can instantly guess that maybe that asset has more risk, something like that. But this is a different story. It is this diversification return which increases expected return, diversification benefit which increases expected return, but it doesn't involve any risk. Right? So that's the reason why Campbell calls portfolio diversification the one free lunch in finance, and maybe the only free lunch in finance. Okay? Because it allows an investor to reduce a portfolio's standard deviation of the return without reducing the portfolio's ultimate return. Right? Therefore, diversification return can be seen as the one free lunch that can raise portfolio geometric return without changing the risk. That's why it is almost free lunch. And table 7 illustrates the mechanics of portfolio diversification return for an equally weighted portfolio using historical annual excess return of Gsti heating oil index and S&P 500 over 1993 to 2003. Okay, and actually I have a link. And then okay, actually a little better idea. So then output X L S O X L S. So basically, this Excel file reproduces this table. Okay. So in the Excel file, okay, we have data from 1994 to 2003, and heating oil excess return. So it is excess return means in this case return over risk-free rate. So let's say it is heating oil excess return over this period. And we have S&P 500 excess return like this. Okay. And this is equally weighted excess return. Okay. And then it is initially equally weighted excess return. Okay, it is initially, so it is like a drifting mix. So equally weighted heating oil and equally weighted S&P 500 looks like this. So basically it is the this one multiplied by this one plus this one multiplied by this one. Yeah, looks like this. And it is initially equally weighted excess return, but because past performance different, so basically winner will get more weight and loser will get less weight. So this is a changing rate over time. So basically this line is the weighted average between this one multiplied by this one plus this one. We have, yeah, something like this. And then for equally weighted portfolio weight is always fixed at 50% and 50%. And for drifting mix, okay, the portfolio weight changes a lot. So on average, heating oil has like 45% weight, and S&P 100 has 55% of weight, right? And then we can calculate arithmetic average. Average is over simply the line, okay? So they are the average. And the arithmetic average is actually, so it is arithmetic average, and geometric average is simply this one. So if we have individual return, so geometric average return is, as you know, this is 1 plus R1, 1 plus R2, 1 plus Rn, and we everything over 1 over n and minus O. Okay, so it's a geometric average return. So applying this formula, geometric average return looks like this. And this is the standard deviation, and this is the variance. The variance I actually with small change. So in continuous time, we will learn about continuous time, but in a very small time period, basically the variance should be the difference, 2 times of the difference between arithmetic average and geometric average in very small time. Okay. So I use that fact to calculate variance, and of course standard deviation is the square root of the variance. Okay. And then let's analyze this portfolio return. So weighted average arithmetic return simply is we have arithmetic average of each individual asset. We have weight of those 2 assets, therefore we can calculate weighted average arithmetic return. Similarly, we can calculate weighted average arithmetic return for unrebalanced portfolio like this. And then impact of rebalancing, not rebalancing. I'll skip this part. And portfolio arithmetic return is basically the average of this one. Okay, average of this one and then this one. Okay, so the difference between this portfolio performs much better than this one, and the difference between this weighted average arithmetic return and portfolio arithmetic return, we can regard the difference as the impact of not rebalancing. Okay, so it rebalances every year, so impact of not rebalancing is 0. In this case, it doesn't rebalance at all. So the difference between these 2 returns is minus 8.47%, which we can regard. Okay, we can think this part as the impact of the not rebalancing. Okay, and then you can of course calculate portfolio geometric return, which is the geometric return of using this formula. Okay, and then portfolio geometric return. Okay, geometric return for this equally weighted portfolio, we can of course calculate that. Okay, so this number is the same to this number, right? So this number is the same to this one. Okay, so it is a geometric average. And then weighted average geometric return is basically this one. So we know individual geometric average. So we can calculate weighted average of individual geometric return. Meaning the average weight, right? Looks like this. For rebalanced portfolio looks like this. Unrebalanced portfolio looks like this. And they are clearly different. Portfolio geometric return is higher than weighted average geometric return, right? Which we already know why it happened. It is because of the diversification effect. So the difference between the two, difference between portfolio geometric return and average weighted average geometric return, we can regard this part as a diversification return. So for rebalanced portfolio, diversification return is 3.36%, and diversification return for unrebalanced portfolio, drifting mix, which is very small. It means by not rebalancing, it loses a lot of the diversification benefit. And we can actually analyze this further. And then weighted average portfolio variance is basically, we have portfolio individual asset variance, and we have individual weight, so we can calculate weighted average portfolio variance for rebalanced and unrebalanced portfolio like this. And then we know portfolio variance looks like this. We already computed that. This is portfolio variance. And because of the diversification decreases by this amount, right? Which is just the difference between aided average portfolio variance and portfolio variance. So because of the diversification, we can reduce variance by 6.7% for rebalanced portfolio and even more for unrebalanced portfolio. Okay? And then we know variance reduction benefit is simply, actually, when we can regard the variance reduction benefit as a half of, in the continuous time actually, variance reduction benefit is basically half of the reduced variance in continuous time. Okay. You have to know continuous time mathematics, but simply you can memorize this for the time being. So variance reduction benefit is actually half of the variance reduction. Okay, and we know the impact of not rebalancing is 0 and minus 3.747%. And by adding this variance reduction benefit and impact of not rebalancing, we can reach these two numbers, which are the same to the diversification return. So again, by this analysis, when we have diversification return, basically we have implicitly two components. Okay. First component is the variance reduction effect, and second effect is impact of not rebalancing our portfolio. That's very important to distinguish. Any question about this expression? So where does this incremental return comes from? Okay, incremental return is basically this part again. Due to diversification, it creates this extra 3%, 3.36% for diversified portfolio and rebalanced portfolio and 0.101% of the extra return for not rebalanced portfolio. And the source of this one is, of course, from variance reduction. Okay. So start with the idea that geometric return of an asset can be approximated as the assets arithmetic return less 1/2 of the assets variance. While the variance measures the volatility of an individual security, a portfolio variance is simply the weighted average of the covariances of individual securities with the portfolio. So the equally weighted average variance of heating oil and stock is 11.44, and the variance of the equally weighted portfolio is 4.52%. The difference is 6.91%. 1/2 of it is 3.46%, which is exactly the diversification return. Okay, so 3.46% is the variance reduction benefit and the diversification return of the equally weighted portfolio. So diversification benefit in the continuous return, actually, this is approximate relationship. Okay, so on asset I's geometric return is equal to the asset's arithmetic return minus 1/2 of the asset's variance, like this. And asset's geometric return in a portfolio context is equal to asset's arithmetic return minus 1/2 of the asset's covariance. So it looks like this. So this part is exactly the covariance as we saw before. So we can regard this part as a diversification benefit of the individual asset. We can derive this relation by some continuous time notation, but we will go over this part later on again. Anyway, the variance of an equally weighted portfolio consists of n securities. We have n securities and equally weighted, so which means that individual assets weight is 1/n. Okay. So we can think portfolio variance, which is average variance divided by n, and 1 minus 1/n average covariance, right? So now we have 1/n here. So variance of this one. Basically, the covariance with itself. Right. Something like this. Okay. And we can factor out 1 over n, which is actually I and j. Right, something like this. We have this relationship. And then for all the possible combination of this I and j, and some of them sometimes we have covariance between itself, so we can something like this, right? And since we have n assets, so we assume all variance are the same. So basically, this part is variance of Ri. No, variance of Ri. So there are n variances, right? So basically, it is 1 over n of average variance, plus basically this part is 1 over 1 minus n of average covariance. Average covariance, and we can rewrite this part as average variance and average correlation and average variance, right? Covariance is simply correlation multiplied by variance. And for an equally weighted portfolio, therefore the diversification return is simply variance reduction, so divided by 2, okay? So variance reduction is weighted average asset variance minus portfolio variance, right? Divided by 2. Sorry, I have to divide this part by 2. Over to here. And weighted average asset variance is average asset variance and minus portfolio variance. We can plug this equation to here. The portfolio variance is simply average variance divided by n plus 1 over n, average covariance. Okay? And then we can rewrite this. Okay? We have the same average variance over here, so we can factor out 1 over 1 minus n. So it is 1 over 1 minus n. 1 over n average variance minus average covariance divided by 2. And then again, average covariance is simply average correlation and average variance. So we can factor out average variance and 1 over n again. So we have this relationship. And so 1 over n multiplied by average variance and 1 minus average correlation over 2. And suppose we have a large number of portfolio. If we have a large number of portfolio, then 1 over n converges to 0. Right? Converges to 0. Therefore, eventually, we have a relationship like this. So, eventually, variance reduction benefit, diversification return is simply the difference between average diversification variance divided by 2. Average diversification variance minus 2. Any question? And okay, now we know how to compute. Now we learned what is the diversification return and how we can contribute, how we can compute the contribution of individual asset to the diversification return, which is called diversification return. Okay, we know how to compute that. Now let's apply that to the real portfolio of the commodities. Okay. Let's go next topic of commodity futures. We already learned what is the futures, right? And we know how to calculate what is the portfolio and how to calculate diversification return and benefit. We can combine these two together. So let's analyze the portfolio return of the futures of PDF, okay, PPTX. So basically this presentation file is based on this paper. Okay, so if you want to get more information about this presentation, you can simply download this paper and read it. You can, I provide the link to this paper. So basically you can just click this one and you can download the PDF file of it. Anyway. So risk and return. So let's first look at the basic facts. Various return. So okay, x-axis is basically annualized standard deviation, and y-axis is compound annual total return. So it's typical chart to analyze risk and return relationship. Okay. So we have various indexes. First one is 3 months T-bill. So 3 months T-bill is almost cash. It has a very low variance, and is okay. Its expected compound annual total return is around 6%, 3%, and we have inflation. Of course, inflation is not an asset. Right? Inflation is an asset, but we put this as a benchmark. And intermediate treasury, it has slightly higher return. Okay, higher return, 8.55%, and also higher variance, 5.82%. Okay. And we have portfolio 50%. Okay, before this, let's take a look at it. So we have S&P 500. S&P 500 has 11% return, which is very high. Okay, only up to 2004. Okay, it is about 11 point, and variance is like 16%. Okay, and GSCI total return. GSCI stands for Goldman Sachs Commodity Index, and it is the most famous index to track the commodity portfolio. Okay, and I will explain more about GSCI. Anyway, it is the most popular and influential index for commodities. Okay. About GSCI Commodities Index, okay, it has a return of about 12.24% and variance 18.23%. So to compare commodities and S&P 500, they are similar, right? They are close to each other. So many people say that commodity return is similar to S&P 500 return, or many people say that GSCI commodity portfolio generate similar return as diversified equity portfolio. Okay. This data clearly shows that they are close. And suppose we have 50% of S&P 500 and 50% of GSCI, because the correlation between the two is relatively low. Therefore, we have some high. Okay, we have high expected return. Okay, high return and at low variance. Low variance. Okay. So basically, this dominate this and this because of diversification effect. Okay. So this is the basic fact. Okay, we have to remember that in this to analyze past performances, commodities generate similar return and risk as equity portfolio. Okay. And now let us look at the GSCI. So GSCI is basically commodity index. It is index for many commodities. So it is individual. It is basically compound average annual excess return of individual commodity futures. So basically, GSCI is the portfolio of commodity futures. Commodity future portfolio of commodity futures composed of this kind of underlying asset. So they are actually futures for copper, futures for cotton, and futures for like propane, tin, coal, electricity, something like that. Okay. And then we can see very interesting pattern. Okay, this blue bar is compound average excess return, and yellow one is T-stat. So this compound average excess return is kind of below its T value, which means that as individual, okay, compound average excess return is statistically not different from zero. Okay. To be different from zero statistically, it should be higher than T-stat of like 2 standard. Actually, it should be like 2 times of T-stat at like 99% significance. But anyway, it is even lower than 1 T-stat, which means that most of the individual futures generate return, okay, not distinguishable from zero. And at the last column is equally weighted index. So suppose we have each commodity futures, we hold them with equal weight, and this return, since individual futures generate return not distinguishable from zero, obviously even the average is not distinguishable from zero. Like this one. So to compare this and this, we have a very interesting pattern, right? Individual futures generate return not different from zero, but once we form portfolio from this individual asset and make GSCI index, then it generates return similar to the equity S&P 500, right? Why is that? Can someone explain why is that? Umerajam, yeah. Okay, why? Can you explain why? Individual asset return is not different from zero, but once we make portfolio, that generates very high return. Okay. Why is that?
Maybe because more people are looking at portfolio than looking at individual.
Okay. Abdul Muhi, how do you think?
What was the question?
My question is, okay, individual asset. So suppose they are underlying asset, so they are individual asset, and its return is not different from zero statistically. But once we collect everything together and make it a portfolio, then it generates return like this. Okay, it generates return like 12%. Very similar to even equity portfolio. Why is that? So individually, junk, once we get it together, it becomes like valuable stock. Why is that?
Why is that?
Yeah. I mean, usually we collect junk together, it is even larger junk, right?
How is the GSI invested? The portfolio of all those commodities?
For the timing, let's assume that they are equally weighted. Okay? Okay, equally weighted. Okay. Why? Why is that? I mean, usually we put chunk together, it is even bigger chunk to, which is even more difficult to remove, right? But in this case, if we put chunk together, it becomes joules, right? In this paper, the authors call this as a turned water into wine example, right? Individually water, if we get together, it becomes wine, right? More valuable wine. So basically, by just forming the portfolio, water becomes wine. Why is that?
That will be of the diversification impact.
Yes, I mean, yes, of course. Until now, we learned about diversification return and diversification benefit, right? So the answer should be like that. Okay, obvious. So basically, because of diversification, individually the return is 0, but collectively it generates 20% performance. So it is free lunch from diversification return. Okay. Let's analyze this further.
What was the answer?
Please explain again.
It was the diversification impact. If you put multiple funds together, that will
Okay, I'll explain that again. Okay, that's the whole story. I mean, that I told until now. But anyway, I'll explain that again because it's so important. Anyway, to summarize, commodity indexes generate equity-like excess return, although its individual constituents do not produce positive excess return. Okay. The geometric return of a portfolio can significantly exceed the weighted average geometric return of its constituents if the securities in a portfolio has very low correlation each other with one another and the securities have high average standard deviation, right? We already showed this mathematically in the previous link. And in addition to that, there is also actual rebalance. So first part is diversification effect, that Wouter just mentioned. Second part is rebalance. When Goldman Sachs generate this GSCI index, and whenever they report daily, actually they rebalance periodically. So there is also rebalancing effect. Goldman Sachs simply do not let the portfolio weight drift away. Okay, they rebalance index individual constituents periodically. So basically, this water into the wine, okay, this effect has there are two causes. One is diversification effect, another is rebalancing effect. Okay. Well, so that's actually as an investor, it's very important implication. If you want to invest in commodities, it is not a good idea to invest in individual asset. You have to invest in portfolio. Okay. It's a huge excess return and very high variance, right? As we saw in the previous slide, each individual asset, the return is not different from 0, right? And individually they have very high variances. So on average, each commodity has risk return of this profile, right? 0 and very high portfolio. Okay? And then once we form the portfolio, then this water becomes wine. First, initially equally weighted and rebalanced portfolio. Suppose we construct equally weighted portfolio, and we do rebalance. Okay, we do rebalance to make them have equal weight. Then its return is 4.28%, and its average standard deviation is around 5%. On the other hand, if we don't rebalance, okay, initially equally weighted and not rebalanced, then its compound excess return is 3.84%, and its standard deviation is like 10%. 10%? Yes, 10%. Right? Something like that. So basically, this is dominated by this one. So if we calculate average Sharpe ratio is for average individual security is 0. and Sharpe ratio for rebalanced one is 0.86. For non-rebalanced portfolio is 0.38, right? Do you know what is Sharpe ratio? Okay, I need to explain Sharpe ratio. Sharpe ratio is basically Sharpe ratio of an asset is basically it is a ratio between excess return of an asset divided by standard deviation of this return, standard deviation of this excess return. So therefore, for individual securities, their excess return, as the previous chart shows, okay, each individual return is not, excess return is not statistically different from zero, so this part is zero, right? So that's why this Sharpe ratio is close to zero. For the others, since we have data, we don't have information about risk free rate, but anyway, we can calculate that. Yeah, we have data. It is already compound excess return, so this is basically ratio between these and this. This is a ratio between these and this. Any questions now? Yeah.
So how to measure the ideal rebalancing rate?
What is the ideal rebalancing
Rate.
rate?
You invested 50% in stock, 50% in bond, but I think there would be some ideal rate, like 60 or 40.
The ideal rate is, of course, if you have information about future return and future volatility, you have to rebalance it tactically. Okay, that would be ideal, but in reality, that would be difficult. Right? So it depends on what information you have. Okay. Now, before we going further, let us investigate what is commodity indexes like GSCI. Actually, we don't have enough time. We have only 5 minutes left. So let's call it a day. Okay. And let's check our homework again, investment theory. So anyway, please don't forget the homework. Okay, R coding for bond pricing, duration, convexity.